Compensation affects our ability to attract, retain, motivate, and engage employees. Compensation is the total of an employee's pay and benefits. This is also sometimes called total rewards. Pay is now the top reason for job satisfaction. Overtaking job security is the top driver of satisfaction in the U.S. workforce. About 57% of individuals in a survey said that compensation is becoming more important to executives and that it has strategic value to organizations. Pay is the most important priority in the North Americas, Latin Americas, and Western Europeans, so HR must pay attention to fair and equitable compensation for organizations' employees. Compensation costs are frequently the largest part of total production costs in organizations today. This dichotomy is important as we strategically think about designing total rewards packages that work in modern organizations. Compensation costs also continue to rise as organizations start to face shortages of skilled talent after the latest recession. The compensation system of an organization includes anything that an employee may value and desire that the employer is willing and able to offer in exchange. This includes compensation and non-compensation components. Many employees consider base pay to be the most important part of the compensation program, and it's therefore a major factor in their decision to accept or decline a job. Wages are paid on an hourly basis, whereas salary is based on a time period, like a week, a month, or a year. A salary is paid regardless of the number of hours worked. Variable pay or incentive pay is pay for performance, and it commonly includes items such as piecework in production and commissioned sales. Benefits are indirect compensation that provides something of value to an employee. Common benefits include things like health insurance and long-term or short-term disability or life insurance and retirement savings options. The first three compensation components, base pay and add-ons and incentive pay, are known as direct compensation. For for-profit businesses, we want to design a mix of compensation and non-compensation components that provide us with the best productivity return for the money we spend. This basically means that we, as human beings, go through a cognitive process to evaluate something, and if we evaluate the process positively, we'll likely continue to be motivated to do the same thing. Expectancy theory proposes that employees are motivated when they believe they can accomplish a task and that the rewards for doing so are worth the effort. Expectancy theory is based on Victor Vroom's formula, where motivation equals expectancy times instrumentality times valence. Let's take a look. For compensation purposes, we've intentionally simplified the theory to show how it affects a person's motivation to perform on the job. Expectancy is the person's perception of their ability to accomplish or the probability of accomplishing an objective. Instrumentality is the perception that a particular level of performance is likely to provide the individual with a desired reward. Valence refers to the value a person places on the outcome or reward, because not all people value the same reward. Generally, the higher the valence, meaning the importance to the individual of the outcome or reward, the better chance of motivation. How does this theory affect the compensation of our workforce? The simple way to answer is to show expectancy in action. An employee will have an expectation to put forth some form of effort at work. This effort is expected to result in some level of performance, and higher effort should result in higher performance levels. This is expectancy. The performance level is expected to result in some type of desired reward. This is instrumentality, and if it does, the employee expects to put out more effort. The reward must be significant to the individual. This is valence, and if it is, the motivation to put forth effort should continue. In other words, as HR managers, if we help employees to get what they want, they give us the work we want to help meet organizational goals. Here are some keys to using expectancy theory successfully. First, clearly define objectives and the performance needed to achieve them. In other words, goal setting is part of expectancy theory. Tie performance to rewards. High performance should be rewarded. Highlight how the reward is a fair return for the performance. What motivates one employee may not motivate other employees, so managers should get to know employees as individuals. Make sure that employees believe that management will do what it says it will do. For example, employees must believe that management will give them a merit raise if their performance meets their goals. Employees' perception of being treated fairly affects their attitude and performance. Equity theory, particularly the version developed by J. Stacy Adams, proposes that people are motivated to seek equity in the rewards they receive, outcomes, in exchange for their performance input. Equity theory proposes that employees are motivated when the ratio of their perceived outcomes to inputs is at least roughly equal to that of other referent individuals. Employees are more motivated to achieve organizational objectives when they believe they're being treated fairly, especially regarding pay. According to equity theory, people compare their inputs, financial rewards, and intangible outcomes to those of relevant others. A relevant other could be a coworker or a group of employees from the same or different organizations. Equity may actually exist, but if employees believe that there's inequity, they will change their behavior to create what they consider to be equity. Employees must perceive that they're being treated fairly relative to others. Managers can also help control employee perceptions of fairness through honest discussion of compensation. Perceptions of inequity hurt attitudes, commitment, and cooperation, thereby decreasing individual, team, and organizational performance. Using equity theory in practice can be difficult because you don't know employees' reference groups and their views of inputs and outcomes. Managers should be aware that equity is based on perception, which may not be correct. Possibly, managers can create equity or inequity, so the manager's role is to be an arbiter of equity. Rewards should actually be equitable. When employees perceive that they're not treated fairly, morale suffers and performance problems occur. High performance should be rewarded, but employees must understand the inputs needed to attain certain outcomes. As HR managers, we need to understand that people will be demotivated if they feel or perceive that they are not fairly compensated. Probably the first thing we need is an honest assessment of how much we can afford or we're willing to afford to pay our employees. This, of course, means that we need to complete an assessment of the estimated revenues from our business operations and determine what percentage of revenues can or should realistically go towards compensation costs. In our analysis, we want to calculate the total amount of annual organizational revenue that we expect to be available for all compensation components, including wages, incentive payments, and benefits. Organizations must have promised a particular level of compensation. One of the worst possible situations a company can find itself in is to not be able to provide what was agreed upon because funds are not available. Some organizations pay people more for longevity or seniority, meaning accumulated years of service within the organization. Other organizations, however, pay more for performance. We may be in an industry where customers have strong relationships with their contact within the organization and where training new employees is costly. A common example of an industry where at least part of direct compensation is based on longevity is the insurance industry for just this reason. Some employees may think as long as I'm here, regardless of my performance, I'll get more compensation over time. This entitlement mentality is true in longevity focused organizations. However, if we're in an industry that focuses on performance and where customers want the best possible product or service, then we probably have to lean towards a performance orientation rather than a longevity based philosophy. Here, organizations might need to base at least a significant portion of their pay on performance. Competencies involve the individual's level of knowledge in a particular area, while skills involve the ability to apply that knowledge set in the field. Examples of competencies include such things as understanding of negotiation and collaboration, an understanding of the basic principles of physics, or problem solving and decision making expertise. Examples of skills related to those competencies would include the ability to actually negotiate contract agreements, apply principles of physics to new equipment design, or make high-quality decisions based on good analysis of a situation. Should we use competency-based or skill-based pay? Again, it depends. Probably the most important thing that we need to consider is our generic strategy. If our generic strategy is low cost, we probably want to hire and train people for specific jobs and will not generally pay them for the knowledge and skills outside of that narrow job description. If, however, our strategy says that we're going to act as a differentiator, we may then gain significant value from paying individuals extra for special skills. However, we're paying our employees for knowledge, skills, and abilities that they may not necessarily use in the organization. This obviously drives up our overall costs of compensation. So we have to ask ourselves whether it's valuable to have somebody who's well-rounded or whether we just need someone who's specifically trained for the job. Skills-based pay is commonly measured based on the number of actual jobs a person can perform. For example, on an assembly line, a person who can work only one part of the production will be paid less than a person who can work 2 or 3 parts. People who can perform multiple jobs are more valuable because they help out whenever they're needed in a particular area. Why would we ever want to pay above the market? The simple answer is to attract better workers and enhance our employment brand. We want good employees to have strong incentives to work for us. One way to enhance our employment brand is to pay above a market rate. We also want better productivity out of our workforce if we pay more for employees. Do better workers generally have higher levels of productivity? In fact, there is some evidence that says this is the case. Efficiency wage theory says that if a company pays higher wages, it can generally hire better people who will be in turn more productive. Efficiency wage theory says that because we have higher quality employees, we get a productivity increase that more often offsets the higher cost of employing them. However, it does not conclude that increased profitability will necessarily follow increased productivity. Based on efficiency wage theory, would we necessarily get lower productivity from our workforce if we paid below the market? In general, yes, but not always. Low-paying firms may save money on pay, but the savings can be lost due to the high cost of turnover as employees leave for better jobs. But just good pay will not retain good employees. So we have to think about our overall pay levels. Are we going to pay at the market average, above it, or below it? We can't pay higher than average if we can't afford to do so, but human resource management professionals consistently conduct research to find out what the average compensation is so they know where they stand. In the end, most of them select the average option. Wage compression occurs when new employees require higher starting pay than the historical norm. In general, wage compression occurs over a significant period of time because we bring workers into the organization in both good and bad economic times. When the economy is doing poorly and overall wages are depressed, people will generally accept jobs for less than they would if the economy were doing well and higher wage jobs were available. Since raises are frequently based on an employee's initial salary or pay rate, those who start at a lower pay than others may stay that way over time, and pay inequity for the same work may increase over time as well. We have to pay more to attract new employees when the overall economy is doing well and when their skills are in high demand. This wage compression can weaken the desired link between pay and performance. Remember the expectancy theory, or take a look at the Greg Learning videos on expectancy theory. This creates significant dissatisfaction on the part of long-term employees because of pay differentials. We can avoid at least some of this dissatisfaction associated with pay differentials between short-term and long-term employees by considering issues related to this concept of pay or wage compression. Many managers think that one of the solutions to deal with this issue is pay secrecy, which means requiring employees not to disclose their pay to anyone else. But the NLRB, or National Labor Relations Board, has consistently ruled over the past several years that organizations may not discipline workers who reveal information about their pay and their work conditions. As long as the workers are participating in protected, concerted activity, the NLRB views this activity very broadly. As a result of these rulings, a company that continues to function with pay secrecy rules and that uses those rules to discipline employees in any way may be charged by the NLRB with violating the NLRA. In addition, President Obama signed an executive order in 2014 prohibiting pay secrecy policies in federal government contractors. In this order, a potential loss of government contracts is punishment for failure to comply. So, enforcing pay secrecy clauses is becoming more dangerous to organizations. However, there may be legitimate concerns about pay secrecy within companies. We may want to keep employees from discussing their pay because if we have two people working next to each other and doing the same basic job, and if there are big pay differences between them, there could be a problem, even if the two individuals have significantly different performance histories. We think we may be able to avoid the problem by not letting them talk about it, but can we really avoid the problem that way? As a general rule, we can't. If you're an employee who is required to sign a contract with a pay secrecy clause, what is one of the first things that pops into your head? You immediately begin to believe that we must be paying someone else more than you. So, one of the issues here is that almost immediately this creates a motivation and job satisfaction problem because of your perception of inequity. Remember, perception is the key to equity. So, there's a perception problem associated with pay secrecy, even if pay secrecy is deemed to be legal for some cases. Employees may assume that the employer is unfair and biased against them, whether that's the truth or not. Therefore, they may try to balance the equation in a different way. There are also potential legal questions that the employer may be trying to avoid: potential age, race, and gender discrimination, or other issues. This may be because of wage compression, or it might be because older workers have fewer current skills than someone who's just out of school. When you get out of college, you should have fairly up-to-date skills, but older employees may not want to learn new skill sets as time goes on. In that kind of a situation, the younger person may be worth more money to the company, but the older person doesn't feel that that's true. So there's some potential for discrimination lawsuits here. All in all, there is evidence that pay secrecy has an adverse effect on performance and voluntary turnover. The minimum wage is the lowest hourly rate of pay generally permissible by federal law. The current federal minimum wage for most employees in the United States as of 2019 is $7.25 per hour. It doesn't matter how the employer pays employees. The net value paid per hour can't generally fall below the minimum wage. Some states and even cities have set the minimum wage higher than this federal rate. If someone is exempt, by the definitions in the FLSA, they are exempt from the minimum wage requirement, overtime provisions, or child labor rules, or possibly all three. If you make under $23,660 per year, you're pretty much guaranteed to be non-exempt under the current provisions of the FLSA. Highly compensated employees paid $100,000 or more per year and at least $455 per week are pretty much automatically exempt from the minimum wage and overtime rules. If an individual is paid more than $23,660 but less than $100,000, then the employee usually must meet a specific set of duties tests in order to fall within an exemption category. You may have heard that in the United States, the minimum weekly salary test was going to increase significantly recently. You'll want to pay close attention to this issue so you can take action once you're employed or managing FLSA standards for your organization. Overtime is a higher than minimum federally mandated wage required for non-exempt employees if they work more than a certain number of hours in a week. Overtime is currently set by the FLSA as time and 1/2 or 150% of the individual's normal wages. If somebody is not an exempt employee and works more than 40 hours in a week, do we have to pay the employee overtime? Yes, in almost all cases. We'll take a look here. But what if a person works more than 8 hours in a day? No, there's no limit to the number of hours per day for the calculation of federal overtime. With very few exceptions, if a non-exempt employee works more than 40 hours in a week, that employee is eligible for overtime. In a few cases, the organization may be allowed to average the employee's work hours over 2 weeks in order to determine whether the individual is eligible for overtime, but this is an exception, not the rule. The FLSA has no requirement for paying anything more than time and a half for any overtime work. Many organizations do provide more than the federal required 150% because of the issue of job satisfaction and organizational commitment. The FLSA has rules on the use of child labor, meaning any workers under 18 years old. If individuals are 18 or older, we can use them in any normal employment situation. However, we can employ 16 and 17-year-olds only in non-hazardous jobs, although their work hours are unrestricted. Finally, there are significantly different rules for 14 and 15-year-olds. Minors age 14 and 15 may work outside school hours for no more than 3 hours on a school day, 18 hours in a school week, 8 hours on a non-school day, and 40 hours in a non-school week. Jobs they can work are limited to retail, food service, and gasoline service at establishments specifically listed in FLSA regulations. Employees 14 and 15 years old may not work overtime. Well, there are some exceptions to these rules for businesses such as family businesses or family farms. These are the general guidelines for child labor under the Federal Fair Labor Standards Act. Comparable worth is the principle about jobs that are distinctly different but entail similar levels of ability, responsibility, skills, and working conditions. In this case, they are of equal value and should have the same pay scale. Comparable worth legislation has been proposed as a solution to the problem of persistent gender inequity in pay. What does comparable worth mean? It is simply similar pay for similar work. Well, this sounds almost like equal pay for equal work stipulated by the Equal Pay Act. The doctrine of comparable worth says that if we can compare your job with that of another person, and if the two jobs are similar but not the same, then we should pay you a similar wage but not necessarily exactly the same wage. So this concept is much broader than equal pay. If comparable worth were federal law, companies would be required to pay people who are in similar jobs similarly, which leads to many questions. What is similar work? Who determines what work is comparable? How do we take market supply and demand for labor into account? And what is comparable pay? There are a few cases where comparable worth is now the law, even though business argue that the laws are vague. Some states have passed comparable worth legislation that apply to state, county, and city agencies, and some have now even passed Fair Pay Acts that apply to all employers in the state. It will be interesting to see what effect these laws have on pay equity and comparable worth, and how such laws will be enforced. There are two approaches to job evaluation, internal and external, though they may be used together. Let's take a look. An external approach involves finding out what other organizations pay for the same or similar jobs through available pay surveys, and it sets pay levels based on market pricing. The vast majority of organizations use this external approach to identifying pay levels. On the other hand, an internal approach uses job evaluation. Job evaluation is the process of determining the worth of each position relative to the other positions within the organization. The most common form of internal job evaluation, the point factor method, was used in only about 1/6 of organizations surveyed. How do we accomplish job evaluation? There are several ways, but the methods usually involve assigning points to activities that occur within a job and totaling the points for the job. Once this is done, we can place a job in a hierarchy and create pay grades. Let's discuss some of the more popular job evaluation methods. Job ranking is simply the process of putting jobs in order from lowest to highest or vice versa in terms of value to the organization. This is the easiest and fastest method of job evaluation, but it has limited usefulness because it's subjective. A second type of job evaluation is the point factor method. The Hay Guide is probably the most well-known point factor method, but there are many others. Point factor methods attempt to be completely objective in form. They break a job down into components, like particular skills or abilities, and then they assign a number of points to each component based on its difficulty. These components are usually referred to as compensable factors. A pay structure is a hierarchy of jobs and their rates of pay within the organization. It allows us to identify what pay range is for each job. Once we've completed the process of creating a pay structure, we'll have the pay range for every job in the hierarchy. From that, managers can determine individual compensation levels based on an employee's performance, seniority, skills, and any other significant contingency factors. A pay structure is composed of both a job structure and pay levels. The job structure is what gives us our job hierarchy. The job structure is the stacking up of the jobs in the organization from the lowest level to the highest level. Each of the jobs within the job structure will end up at a particular pay level. On the other hand, a pay level, frequently called a pay grade, is made up of many different jobs, and each pay level has a maximum pay rate and a minimum pay rate. To establish pay levels and determine maximum and minimum pay rates for particular jobs, we have to look at some market factors. To set the minimum value for a particular pay level, we have to look at the applicable labor market competition, meaning labor supply versus demand for labor. On the other hand, How would we determine the top of the pay level? We have to look at something called product market competition. Something you always need to keep in mind as an HR or manager in an organization is how much you can pay for labor, meaning what is the job worth? The decision of whether or not to pay someone more for a particular job is not a function of liking or disliking an employee. It's a function of being able to pay only a certain amount because of the product's market value. Next, we look at benchmarks from pay survey data that we reviewed earlier to put benchmark jobs into a pay level where they belong. Once we place some benchmark jobs in a plot of our pay levels, we can get a market pay line, sometimes called a pay curve, a line that shows the average pay at different levels in a particular industry. After going through this process for a particular pay level, we end up with a rate range, which provides the maximum, minimum, and midpoint pay for certain groups of jobs. A trend over many years now has been to lower the number of pay levels using one of two options, either delayering or broadbanding. Delayering is a process of changing the company structure to get rid of some of the vertical hierarchy reporting levels in an organization. On the other hand, broadbanding is accomplished by combining multiple pay levels into one. So, when we're all done with our pay structure, we will have created that hierarchy of jobs from highest to lowest, irregardless of the decisions we make. It's all about relative value of each job in an organization. Variable pay is compensation that depends on some measure of individual or group performance or results in order to be awarded. People respond to incentives, and rewards and recognition are combined to create motivational incentive systems. We want to be able to reward our best employees so that they feel that they're being recognized, because recognition is a highly motivational tool. We are rewarding them for their past performance, but we are doing it in a hope that they will want similar rewards in the future and therefore will repeat the desired behaviors. Variable pay moves some risk associated with having employees and the associated payroll costs from the firm to the individual. Human resource management is a critical component of meeting organizational goals because without the right people with the right types of education, skills, and mindset, we cannot expect to accomplish the objectives that we set for ourselves. Incentive pay has the aim at the strategic goals of the organization in order to make any sense. Individual incentives reinforce performance of a single person with a reward that is significant to that person. Here are some more common advantages of individual incentive plans for an organization. Individual incentive programs, if designed correctly, make it easier to identify individual efforts. Recall that expectancy theory shows the need to reinforce individual performance levels with rewards that are significant to the individual. Individualized incentives allow us to do this to a much greater degree than group incentives. Individual incentives provide a direct link between performance levels and the rewards received, pay for performance. Less productive employees who see others getting valued rewards for performance may be convinced to increase their performance levels in order to get similar rewards. Here are some more common disadvantages of individual incentive plans for the organization. Many jobs have no direct output. It may be very difficult or even impossible in some jobs to identify individual output on which we can base an incentive. If rewards are distributed based on personal performance levels, a perception of favoritism can be created if we don't clear why some are provided with greater incentives than others. Individual incentive plans require that we keep track of individual efforts. Supervisors must develop and maintain comprehensive records to manage the program. Individual incentives may not be acceptable in team-oriented organizations or in societies which the culture is highly collectivist. Individual incentive plans work best when there are distinct, measurable outcomes for individual efforts and when individual jobs require autonomy. Group incentives provide reinforcement for actions of more than one individual within an organization through compensation strategy. Here are some of the advantages of group incentive plans. Group incentives, to no one's surprise, tend to encourage higher levels of teamwork and group cohesiveness. They can foster loyalty and trust between group members. When we broaden the individual's job by giving them more and different things to do, we can ultimately increase motivation and productivity. By allowing employees to see how their actions affect others, we create positive psychological states that improve performance. Group incentives, at least in some cases, tend to require less supervision. Developing incentive programs for groups is less difficult than creating separate incentives for each individual in the organization. Here are some of the disadvantages of group incentive plans. Social loafers or free riders may be able to stay hidden within the group while allowing others to do the majority of work. Individual effort and results may get lost in the group. If the group is highly cohesive and has low performance norms, individual high-level performers may be pressured to lower their output to conform to those group norms. There might be a breakdown of communication and/or cooperation among individuals within the group, and they might begin to compete with each other instead of cooperating. Group incentive plans work best when we need people to cooperate and when individual contributions are difficult to identify. A bonus is a lump sum payment typically given to an individual at the end of a time period. A bonus does not carry over from one period to the next. Over what type of period do we usually provide bonuses? Generally, they're provided on an annual basis. How would a bonus program have to be designed in order to motivate increased performance? We would need to identify specific and measurable goals that the individual could affect and a bonus that would cause the individual, assuming we're making this an individual incentive, to change something that they're doing to perform at a higher level. If they can be reached in terms of a measurable goal, they would receive a bonus. Bonuses can also be used at the group level, but are generally considered an individual incentive. In our globally competitive environment, many organizations are giving bonuses to keep valuable employees from leaving for other organizations. Most bonuses of this type will typically be paid out in several years based on performance goals. A commission is a payment typically provided to a salesperson for selling an item to a customer. So if you sell a $100 product and you're on a 10% commission, you would receive $10 for that sale. Commissions can also be used at the group level in some cases. In general, commissions are a good individual incentive as well. Are commissions sometimes ineffective as individual incentives? If not implemented correctly, they can certainly be unproductive and maybe even harmful. The salesperson may ignore the customer's needs or desires in order to sell something that makes the salesperson more money. If the salesperson gets the customer to buy something they didn't really want, it may harm the long-term relationship between the organization and the customer. For a commission incentive program to work, it must provide significant return to the salesperson who is successful in selling to the customer, but it also has to provide a disincentive to harm the customer to make a quick sale. What are organizations trying to do to determine whether a salesperson may have done something or anything to damage the long-term relationship between the customer and the company? In some cases, car dealers are making customer complaints part of the commission structure. In this case, if a salesperson gets too many complaints, part of their commission will be reimbursed to the dealership. Merit pay is a program to reward top performers with increases in their annual wage that carry over from year to year. Merit pay is different from most other individual incentives. If an individual gets merit pay, consistently over time, their annual pay can become significantly greater than others who do not consistently get merit increases. In general, merit pay works as follows. The organization announces a merit pool available for pay increases in a given period of time, usually annually. The merit raises will be given to top performers in the organization based on performance evaluations. Frequently, individuals who receive either outstanding or excellent marks will get merit increases above the average, while average performers get a lower raise, and those who receive below average marks don't get a raise at all. But there are some significant potential problems with using merit pay as an incentive. First, the issue is that merit pay is typically a very small percentage of the individual's total pay, which makes it very difficult to use it as a motivator to perform. Remember that people need to feel that the reward is significant for them to be motivated. In many cases, merit raises amount to only an extra 1% of pay in a given year. Many employees won't consider this significant. Another major issue is inflation of the performance appraisal process. If the company does not set limits on how many employees can be judged as outstanding or excellent, nearly everyone tends to become outstanding or excellent. In order for merit pay to be valuable as an incentive, it must be significant, which means that it must be more than 1% of the employee's pay. However, there's another problem here. Remember that merit pay increases the individual's pay from one year to the next, and it carries forward. So if merit pay is 5 to 10% instead of 1 to 2%, we can end up with employees who break right through our maximum wage in a specific level very quickly. Merit pay is one of the most frequently used individual incentive programs in organizations, and it can be used in some team-based situations as well. We want to reward only true top performers. If we do so, this means that those who are rewarded are truly recognized as having exceptional ability, and it also means that limited amounts of merit pay cash can provide a larger merit increase to those who deserve it. If we provide all employees with merit raises, the pool of funds must be spread out among everyone, and the small amount of the supposed merit increase won't amount to much. In a straight piece rate compensation system, the employee gets paid for every piece they complete. A differential piece rate system provides the employee with a base wage to complete a certain amount of work. One important problem with piece rate compensation systems is an issue of quality. If we pay employees by the piece, they may make lots of pieces with lots of quality problems because they're trying to do work too fast and not paying attention to how well they're doing the work. There may also be a problem in determining where the standard is going to be set for a differential piece rate system, and there are other potential problems as well. However, in some situations, a piece rate plan can be an incentive to produce at a faster rate, and if we control quality, this can provide an outcome or a competitive advantage to an organization looking to do so. Clear standards tell the employee what they need to do in order to benefit from the piecework pay schedule. If they will not be given credit for certain items that don't meet quality standards, they need to know it up front. If they'll have to rework any items that aren't correct, they need to know that too. The other key to effective piecework plans is feedback. Employees need to know how they're doing as they go through the work week. Feedback gives the employees information about the significant reward that they seek and can motivate continued performance. Generally, this time will be shown in a standard hour manual. The individual doing the job will get paid based on the standard time to complete the job, but good workers can frequently complete the work in less time than the standard amount of time. Like a piecework plan, standard hour incentives can cause some quality problems. So most standard hour plans also require that if there are any quality problems, the job has to be redone. The worker must do the rework for no additional pay. This is one way to make sure that speed doesn't create poor quality. Standard hour plans, like most individual incentive programs, can be used for groups if the group is responsible for the completion of the work. Standard hour plans are used heavily in automotive and heavy equipment repair and in other areas like heating and air conditioning services. We need to keep an ongoing record of the actual times to do the jobs so we can adjust standards accordingly and not over or underpay for each job. Non-monetary recognition can come in many forms, like service awards, but evidence says that honest praise is one of the most effective motivational tools that management has at its disposal. Recognition can be a powerful incentive, so we need to use it effectively to motivate our employees. In order for this type of recognition to mean something, there has to be a set of criteria that one must meet in order to receive the recognition. The employee has to do something extra, above and beyond what others do, in order to be recognized. Why are ceremonies important? It takes a lot of time and man-hours to do them. These ceremonies are carried out to recognize special efforts by members of an organization because the folks in charge know that other members will see ceremonies, and through social learning, they can determine that performance at a higher level means being recognized for that level of performance. If these type of service rewards have strong requirements for eligibility, they can become a powerful motivational factor in any workforce. Employees want to know that their organization values their contributions and cares about their well-being. Giving praise is simply complimenting the achievements of others, and this recognition increases performance. Ken Blanchard and others have popularized a giving praise model in the 1990s through their best-selling book, The 1-Minute Manager. They developed a technique that involves giving 1 minute of positive feedback. This giving praise model is an adaptation. It includes 4 steps. First, tell the employee exactly what was done correctly. Second, tell the employee why the behavior is important. Third, stop for a moment of silence. And fourth, encourage repeat performance. As you can see, giving praise is easy and it doesn't have to cost any money. It's almost always a much better motivator than giving a raise or other monetary rewards. Other non-monetary recognition, besides praise, also increases motivation if the individual considers it to be significant. Profit-sharing programs provide a portion of company proceeds over a specific period of time to the employees through a bonus payment. These programs are designed to cause everyone in the organization to focus on total organizational success and, most importantly in this case, profitability. If the company doesn't have any profits, employees may not be motivated to work harder. The company can and frequently does manipulate net profit in many ways in order to pay less in tax on corporate profits and at the end of the year, and in some cases minimize profit sharing. These tactics obviously create other motivational and ethical questions as we look at the total rewards package. Another issue with profit sharing as a motivator is that it's focused on total organizational profitability. This excludes individual and team contributions to overall organizational success. To motivate employees, we need to be sure that management is not manipulating factors to minimize profits so it doesn't have to pay as much in profit sharing. Again, these ethical and organizational questions become important when we look at the total mix of rewards used in an organization. This allows the employee to see their efforts affecting profitability of a firm overall through great implementation of profit-sharing plans. Gain sharing is similar to profit sharing because in each case, the gain, in either profit or some other factor, is shared with the employee who helped to create the gain. Gain sharing can be accomplished using any organizational factor that costs the company money and that can be analyzed and modified for performance improvement. Originally, gain sharing usually used corporate revenue, but today, many gain sharing options exist. As with profit sharing, we have to show employees how they can affect the desired outcome in order for them to be motivated to change the way they work. How do we incorporate gain sharing effectively in the organization? It's pretty straightforward, but easier said than done. Here's the process. We establish objectives, identify the performance measure, usually a per unit value, determine how to split the gain between the organization and the employees, and then provide the payout when earned. An employee stock ownership plan, ESOP, ultimately allows at least part of the stock in the company to be provided to the employees over a period of time based on some formula. An ESOP is actually a retirement benefits plan because the company puts the tax-deferred stock in a trust for eventual use by employees who retire. Because an ESOP is basically a qualified retirement benefits plan, it has a significant tax advantage to both the firm and the employee in most cases. A second major reason for giving employees stock in the company is to cause them to act more like owners in that company. But does an ESOP always work as intended? Of course not. Because an ESOP is like other group incentives, it's subject to the same potential problems and requires the same lack of manipulation and employee training. Stock does, however, have a unique potential problem. The entire company typically has to improve in order for the value of its stock to improve. Even if employees are highly motivated and work really hard, the value of the stock can actually go down for many reasons that are outside the control of employees. First is a stock option plan, and the second is a direct stock ownership plan. Stock options are usually offered to an individual employee to allow them to buy a certain number of shares of stock in the company at a specified point in the future, but at a price that is set when the option is offered. The intent here is to motivate the employee to work to improve the value of the company so that when the option to buy the stock comes up in a year, the price of the stock has increased, giving the employee more value than what they paid for. A discount plan is similar to stock options, but instead of giving you the option to buy the stock in the future, they let qualifying employees buy the stock essentially any time, usually at a discount. ESOPs, stock options, and stock purchasing gives employees ownership in the company, but the big difference is that with an ESOP, the employees are given the stock over time. Stock options and stock purchasing don't always work as intended for essentially the same reasons as ESOPs. The employee can simply buy stock and then quickly sell it for a profit so that they're no longer an owner of the company. The same problem can occur with stock purchases, depending on the arrangement. These are important factors when considering using stock options and other stock purchasing plans in terms of your total rewards mix. As it turns out, there are many reasons why incentive systems might fail to motivate the workforce. Let's take a look at some of the more common ones. Even the best incentive plans won't work with bad management. Managers are at the core of any incentive program because they have to keep track of individual and group performance in order to reward those who perform the best. Management also has to monitor the program and adjust things as necessary when the environment or the organization tasks change. If employees can't figure out what they need to do in order to receive incentives, they won't do anything different. Complex programs will almost always lead to failure of an incentive program because workers don't know how to reach the goals, or in many cases, even what the true goals are. In addition, failure to successfully communicate the plan to employees creates the same problem. The employee won't know how to reach the goals. If a plan takes away from base pay in order to add incentive pay, the employee isn't really gaining anything. The net result is the same. The employee will see right through such a rewards program. Even if there's a minimal increase in pay, often employees will figure that the extra effort required is not worth the return. Again, we see expectancy theory in action. We have to tailor our incentive programs to the things that matter to each specific employee and the organization. Frequently, we create reward programs that promise a return to the employee, but we base the proposed reward on something the employee can't do anything about. Think about company profit. What can the housekeeping staff and many others in the organization do about profit? So, if the desired outcome is to increase profit, the employee doesn't know how to affect profitability. In order for an incentive plan to motivate, the employee has to know how they are doing compared to the desired outcome. They also have to know how they're impacting company performance if that's a factor. At the end of the day, people have to know how they're doing compared to program goals, organizational performance, team contributions, and any other factor that's used in the incentive mix. Questions covered in this course will discuss 4 major challenges when it comes to incentive pay. One of the things that we've found over the past 20 years or so is that incentives don't work as well as we might have thought they would, at least in some cases. There's some recent evidence that group incentives work significantly better than individual incentives when people in the organization have to cooperate or coordinate with one another in completing a set of tasks. If we can create the connection between how an employee acts and how they gain from it, then we can create strong performance incentives. If not, the incentives won't work. Remember from our discussion of bonuses that in order for an incentive to continue to motivate, it can't be considered an entitlement. An entitlement is something that the employee feels they have the right to receive from the company. The current group of younger employees entering the workforce has been called the entitlement generation because the expectation that they are entitled to certain prerequisites just for becoming an employee. Consultants are seeing that in many cases, what was intended to be pay for performance in organizations deteriorated into a bland set of rewards based on an entitlement mindset. Another of the challenges associated with incentive programs is the tendency of people to do only what is measured and paid for in that incentive program. However, assuming that this might be a problem in some cases, one way to combat it is to make the incentives specific but make the overall job performance a part of any variable pay program. Extrinsic rewards are valued returns, such as incentive pay for performance, to the individual in exchange for doing something that the organization desires of the employee. When we cause the individual to believe that the rewards are for the right things, it lowers resistance to external rewards. Anytime we're developing a variable pay plan, we have to consider what we need to do to make it work. The incentive program must be based on the goals of an organization's strategic plan, the direction of the company. Any incentive program needs to provide performance incentives to all individuals involved in the process that's being targeted. If people can't understand what's expected of them, there's no way they'll reach the goals that we set. The incentive offered should be based on factors that the individual or group can affect. We have to ensure that our incentive program identifies the goals of the plan in smart fashion. That means the goals are specific, measurable, actionable, realistic, and time-based. We utilize base pay to allow our workforce to meet their basic needs. Remember, Maslow's hierarchy of needs is important when it comes to the total reward mix. This base pay will very rarely motivate additional action on the parts of our employees. Compensation studies will tell you that different things about what is considered to be significant when it comes to total rewards. A good recommendation would be that at least 10% of overall pay, and in some cases 20% or more, are devoted to incentive pay, making it meaningful and valuable to employees. Meticulously measuring performance using multiple metrics and vigilantly calculating the rewards to be provided to a person to reach overall goals is critically important in incentive pay. Make sure to keep the time between the performance and the reward as short as possible. Remember from our discussion about praise and other non-monetary recognition that not everybody is motivated by cash. When goals are not met, do not apply rewards. It seems silly to have to say this, but in many cases, you want to reward your employees even when they don't quite meet the goals that were set. We have to make the incentives specific, but make the overall job performance a part of any variable pay program. Don't forget that critical guideline in developing the right mix. One easy way to do this is to provide a caveat in the incentive program about overall job performance. Preferred Provider Organizations, PPOs, are a kind of hybrid between traditional fee-for-service plans and HMOs. PPOs act like HMOs in that they prefer but do not require that you have a primary care physician within their medical network and that you go to that primary care physician before going elsewhere for medical care. However, PPOs do not require that you have a referral from the primary care physician to see a specialist. If we compare PPOs and HMOs, we see that the advantages of PPOs include the ability to see any physician and use any medical facility. In addition, similar to HMOs, PPOs cover preventative care. An HSA allows the employer and employee to fund a medical savings account from which the employee can pay medical expenses with pre-tax dollars. The money in this account is used to pay for medical services for the employee and their family if desired over the course of a year. In an HSA, you pay the full cost of each of the medical services used in a plan year from the HSA account. There are no co-payments and there are no deductibles. HSAs are portable, so we can take our HSA balance with us if we change employers. One of the biggest differences between HSAs and HRAs is the portability of the account. HRAs, another pre-tax sheltered fund, do not go with the employee if they leave the company. Employers choose deductibles to require and manage the account in other ways, such as through managing pharmacy benefits and maximum out-of-pocket costs. One of the problems that we can quickly see with an HSA is that our services in a particular year could cost as much or more than $3,350, especially if we had to have surgery or some other major medical issue. This high-deductible healthcare plan, known as an HDHP, is a major medical insurance plan that protects against catastrophic healthcare coverage costs and is associated with HSAs. A very common high-deductible health plan would pay for medical costs in any given year that total more than $10,000. At first glance, this looks like a large out-of-pocket expense for the individual employee. It is. But one of the big advantages of HSAs and MSAs is that the individual can go to any physician or medical facility. The HSA can cause people to realize that medical costs a lot more than their co-payments. It's expected that HSAs and MSA accounts will continue to become a more significant proportion of the healthcare plans provided by employers. A utilization analysis is a comparison of program costs with the rate of the program's usage by the members of the company. In other words, is the company getting a valuable benefit out of the program, or could the same money be spent in a different way to get better returns on money spent? Health insurance is one of the easiest things for us to do a utilization analysis on because we are provided information on the services that our employees use by the insurance company. If we have a strong case, we need to go to the insurance company and request that they lower our rates to match our utilization of services using such information. A defined benefit plan provides a retiree with a specific amount and type of benefits that will be available when the individual retires. For instance, a simple defined benefit plan might provide that employees who work for the company for 25 years will get 60% of the average of their 2 highest years of pay. Because it's a defined benefit retirement plan, the employee knows exactly what their retirement will be. Unlike with a defined benefit plan, under a defined contribution plan, the employee does not know what their retirement benefit will be. Defined contributions plans identify only the amount of funds that will go into a retirement account, not what the employee will receive upon retirement. The employee only knows what their contribution to the retirement fund consists of. If the retirement funds are invested successfully, growing significantly over time, the individual's retirement account will be able to pay much higher benefits than if the funds were not invested successfully and don't grow very much. Defined benefit plans used to be the most common type of retirement plan, but they have been overtaken by defined contribution plans. Some would say for legitimate business reasons associated with cost and ongoing sustainability of defined benefit type arrangements. In the case of the defined contribution plan, the risk of slow growth of the investment shifts to the employee. These plans meet federal and state guidelines for favorable tax treatment and have added value to both employers and employees. 401k accounts are available to nearly all employees of corporations as well as most self-employed persons. A 401k retirement plan is a savings investment account for individual employees of corporations. A 403b retirement plan is very similar to the 401k, with the exception of that it's used for nonprofit entities. Both the employee and the employer are allowed to contribute funds each year to the employee's 401k or 403b account, with the employee allowed to contribute up to a maximum of $18,000 per year. Contributions to these accounts are made on a pre-tax basis. This means that when funds are put into the account, they do not count as taxable income for the individual. Once the individual retires and begins to remove funds from the account, they pay income taxes on the distributions at their current tax rate, which tends to be lower at the time of retirement. The earliest point at which the contributor can withdraw money without incurring a penalty from a 401k or a 403b account is age 59 and a half. Many employers that offer 401ks or 403bs provide a matching contribution up to a set maximum. Matching dollar for dollar is a 100% return on your investment. For example, an employer might allow a 100% match of employees' contributions up to a $2,000 maximum. SEPs are primarily used for self-employed individuals and members of small companies. A SEP allows for a contribution of up to 25% each employee's pay up to a maximum of $52,000 into a person's IRA each year. Because the owner is not an employee with pay, the self-employed person can tax defer a set percentage of company profits. A SEP can also be used by a person who has a job that has retirement benefits and who is also self-employed to defer taxes to save more for retirement. What makes a SEP retirement plan valuable to a small business is the lower paperwork burden compared to a 401k or 403b retirement account. Employed proprietorships without any employees can also get SEP retirement benefits, making it a great, flexible option for small and sole proprietorship type businesses. In other words, they reduce your taxable income by the full amount of the contribution in the year in which they were contributed to the account. Both IRAs and Roth IRAs can supplement the amount an individual is contributing to a company-sponsored 401k account because we're allowed to contribute to both. An individual can contribute a maximum of 100% of their income up to $5,500 per year into a standard or Roth IRA. The Roth IRA is basically the same type of account as a regular IRA, with the exception that the Roth IRA front loads or requires that we pay taxes immediately for funds put into the retirement account. With a standard IRA, you pay no tax on the funds when you contribute them, but pay taxes at your current rate when the funds are withdrawn. If you expect to be in a much higher tax bracket later in life, it makes sense to pay the taxes at your lower current tax rate instead of paying higher tax rates later. Paid time off, PTO benefits, include a group of options such as vacation time, severance pay, personal time off, sick days, and holidays. Some companies provide an all-encompassing PTO plan, sometimes called a PTO bank, that allows the employee to use their paid time off in any way they wish, whether for sick days or vacation, holidays, or any other purpose. These benefits contribute to approximately 7% of the average employer's total cost of wages and benefits, a little over 10% of direct wages. PTO benefits aren't mandatory at the federal level in the United States at this point, yet most employers provide at least some holidays time off, as well as sick or vacation time in terms of paid time off benefits provided. In addition, you need to be aware that some states have already passed or are currently attempting to pass mandatory sick leave and even in some cases annual leave and other PTO laws. Although federal law does not currently require any paid vacation time, the majority of U.S. firms provide paid vacations to their employees, according to the U.S. Bureau of Labor Statistics. The average time provided was about 8 days after 1 year of service in 2017, while workers with 10 years of service averaged 14 days. Approximately 92% of employers in the United States provide sick leave of some type to their employees, whether in an all-encompassing PTO plan or specifically designated sick days. Paid sick leave can offer employees relief from loss of income associated with having to miss work due to an illness. In 2017, the U.S. government identified 10 federal holidays, and many companies also observe some local, state, and religious holidays as well. Many organizations today provide time off for a wide variety of personal needs. Many organizations allow employees to use such leave to visit their child at school or accompany them on a field trip, just to name a few. Leave is an effort to maintain or improve job satisfaction and overall employee engagement in efforts to engage employees and ensure organizational commitment on the part of those employees. Group Term Life, or GTL, provides for a survivor payment to occur only if the employee dies during the term that is covered by the insurance policy. It's also a valuable benefit to the employer because it's eligible for a tax deduction up to $50,000 in coverage if it complies with IRS regulations. This means that both the employee and the employer directly benefit financially from providing this type of total reward. A fairly standard benefit would be 1 to 2 times the individual's annual compensation in terms of overall policy coverage. Many organizations will allow the employee to add this coverage at the group rates, which means generally a very good deal for the employee in terms of investment in life insurance. In addition to GTL, employers can provide permanent or whole life insurance as an option in their total rewards benefits package. This type of insurance can be either short or long-term in nature, and some organizations offer both. Short-term disability is insurance against being unable to perform the essential functions expected of the employee at work for up to 6 months due to illness or injury, not necessarily work-related. This provides valuable protection because most long-term disabilities policies do not provide replacement income until the employee completes a 180-day elimination period, a period during which they're unable to work. Because 71% of Americans say that it would be difficult to pay their bills if their paycheck were delayed for more than a week, waiting 6 months would likely create a massive hardship for a disabled worker. Remember, too, that Social Security disability doesn't apply unless the employee is going to be disabled for at least 5 months, so short-term disability can bridge this gap in income. Long-term disability policies cover employees who are unable to work for more than 6 months due to illness or injury, again, not necessarily work-related. This is a supplemental benefit to Social Security disability payments because remember, Social Security payments are not designed to replace 100% of the employee's pre-retirement or pre-disability income. Long-term benefits most often begin once the employee has exhausted their short-term disability benefits. Benefits from group long-term policies will generally continue until the employee reaches their eligible retirement age under Social Security or they're able to return to work. Companies may provide a wide variety of employee services as benefits for their workforce. This includes things like educational or tuition assistance being one of the most common benefits in this group. Other common employee services include on-site childcare or childcare vouchers, elder care assistant, executive coaching, company-provided gyms, and fitness facilities. Employee services are provided in order to minimize disruptions to the employee's work life. They provide employee services to lower stress and allow employees to concentrate on the job. Service that takes the employee away from being able to focus on work is a legitimate target for an employee service benefit. If an unlimited amount of flexibility is allowed in a benefits program, some bad consequences can occur. Let's take a look. The employee has several basic modules from which they can choose to provide a set of benefits that match their life and family circumstances under a cafeteria-type plan. This allows for flexibility for the employee while managing the ability of the employer to control overall costs and benefit spending as well. In a Core Plus plan, we have a set of benefits called the Core that are provided to everyone, and then employees are allowed to choose other options to meet personal needs and desires. The Full Choice Plan provides complete flexibility to the organization's members. Each employee can choose exactly the set of benefits they desire within specified monetary limitations. The bottom line is that flexible plans are really gaining ground because our workforce is much more diverse than it used to be. Benefits need to match the needs of our workers, but we have to remember that the more flexible the plan, the more expensive it can be.